Let me begin by welcoming everybody. My name is Shamsuddin Usman. I am the Chairman CEO of Susman Associates. I've already had the opportunity to welcome our panelists. So now I would like to extend my appreciation to our participants. For us in Susman Associates, this is a continuation of our corporate social responsibility initiatives, where we have tended to focus on a number of activities that have to do with the development of the Nigerian economy in general, in this particular case, of the Nigerian capital market. Some of you would recall that 2 years ago, our firm sponsored a study on the voice and voting power of retail shareholders in the Nigerian capital market. For that study and all parties that participated in it, the operators, regulators, and other key players in the market, I would like to acknowledge the support that we received from the CAC, the SEC, the Nigerian Stock Exchange, Big IBTC, Chapel Hill Denham, and all the shareholders associations that participated. Today, we have another history-making event, given the level and quality of the panelists that are topmost players of the capital market. Also, the enthusiasm of participants. The number of questions that we have received already is an indication of how enthusiastic the participants are. So I'd like to welcome all of you, but a few words of context. The Nigerian capital market reached its peak in 2008. And since then, it has been actually struggling to get back to that peak. This was followed immediately by the 2008-2009 global financial crisis. And I recall that I was Minister of Finance then. I led a team to go to Lagos and sit down with all the key market operators to discuss what we needed to do, government, regulators, operators, to reverse the negative trends in the market at the time. Unfortunately, in 2016, the Nigerian economy went into a recession. So again, any effort at recovery were again so reversed by that development. Fast track to 2020, and we have had two very unprecedented events. The 2020 COVID-19 event, which we are still in the middle of, which was followed closely by the drastic fall in oil prices. These two have had significant impact, not only on the Nigerian economy, but also on the Nigerian capital market. And our distinguished panel today is here to discuss these issues, dissect them, and come up with solutions as to how we can reverse the trend, the negative trend in the market. I will not go into very detailed introduction of the panels. When we come to each and every one of them, I will then introduce them individually, but briefly, because we've sent you their detailed bios, and I'm sure you are very familiar with all of them. They are very well-known figures anyway. By way of housekeeping, we have a very tight program, and we have agreed the timelines with the panelists, with the speakers. Each one will have a maximum of 12 minutes to make their presentation. After the main panelist presentation, we'll have a 2 minutes interlude, during which we'll ask all the participants to fill a survey questionnaire online, which you will be administered. It's just 10 questions, and it's a yes and no answer. So we hope that shouldn't take time. Then the discussant will come in and take about 10 minutes. And that will leave us at least 30 minutes for Q&A. We've received quite a lot of questions already. Please be assured that we'll send you to your emails presentation slides of all the speakers, plus a summary of the webinar discussion. If any people are interested also in this study on the voice and voting power that we did by our firm 2 years ago, please indicate by email and we'll send the copy to you. It's now my pleasure to invite the first speaker, and I will do it. My choice of the first speaker is partly dictated by the fact that it is his birthday today, but also that his platform is actually the one that provides the biggest platform for the market as well. It's the biggest marketplace as far as the capital market is concerned. So it's my pleasure to invite Mr. Oscar Onyema, the CEO of the Nigerian Stock Exchange, to make his presentation. Oscar, over to you.
Thank you very much. Thank you very much, Dr. Samsudeen Usman. Good morning, distinguished ladies and gentlemen. I'm very pleased to participate in today's discussions alongside such eminent personalities as panelists. I must thank Susman Associates for inviting me to join the conversation today. I've been asked to talk about the strategies for the recovery of the Nigerian capital market post-COVID-19. And my presentation is going to be short in keeping with what the chair of the occasion has already said. If we go to the next slide. Next slide, please. Thank you. So Nigeria was actually hit by a twin challenge of COVID-19 and crude oil price shocks. And this is as we were recovering from the shocks we saw in 2016, where the country went into a recession. And we're now projected to go back into recession for 2020, just given the challenges that COVID-19 and oil price shocks have done to the country. If you look at the Nigerian Stock Exchange All-Share Index, it is highly correlated with crude oil prices. That is clearly shown in the chart to the right of your screen. And so the All-Share Index is already down year to date 6%. I must say that if you look at other African markets, and indeed markets around the world, there was a lot of volatility as we went through the thick of the COVID-19 crisis and oil price shocks. And so we're now in recovery mode, I should say, because the market actually lost a lot more than 6%, and we're now back to about 6%. If you go to the next slide, some of the things that the exchange did to keep the market open were really based on two objectives. We wanted the safety of all of our stakeholders, and we wanted to make sure that the market continued to be accessible for people to express their opinion as to whether they want to buy or whether they want to sell, and to allow people to be able to engage in capital raising as needed to support their operations during these challenging times. We rolled out our business continuity plan, which allowed us to shut down in fact, all of our trading floors across the country, and begin to give access to staff remotely to work, and the broker-dealer community and other people that wanted to trade to access us through one of our platforms, either fixed protocol or XNet platform or the virtual private network. That has worked seamlessly until today. The market ecosystem continues to trade seamlessly. We also gave access to our issuers and other stakeholders through multiple platforms, X-Issuer, X-Whistle, X-Boss, to be able to submit market-moving information and be able to submit all their regulatorily required submissions that would allow for an efficient market. And that has worked very well as well. We went further to provide certain palliatives to various stakeholders. For issuers, we granted extensions for them with regards to their audited financial statements and quarterly statements. We then engaged in thought leadership by publishing guidelines around virtual board committee and management meetings for stakeholders, guidelines for dealing members on measures to protect themselves and reduce vulnerability as a result of cybersecurity attacks and things like that, given that most of them are now working from home, especially during the lockdown. The exchange waived the enforcement of a number of rules, including the related party transaction rules, and just made it compulsory for companies to get board approval and to disclose such approvals within 24 hours. Finally, from a CSR perspective, we committed 100 million naira towards the fight against COVID-19, 60 million to the Capital Market Support Committee for COVID-19, and 40 million to Mask for All Nigeria campaign. Next slide. These campaigns have done very well. They've been well received, and they've been disseminated across the whole country. So we're happy that we're part of the fight and part of the solution to the COVID-19 pandemic. We believed that collaborating with policymakers and regulators was going to be key to fighting the COVID-19 and oil price shocks, the twin shocks, I call them. And so we engaged with government earlier on to be declared as an essential service during the lockdown. That allowed our people to be able to move around, to continue to keep the market accessible. We also worked with the Securities and Exchange Commission to provide various palliatives to the broker-dealer community and to work with trustees of bond issues to make sure that if they needed to restructure, they could do that seamlessly. The exchange then engaged with various policymakers, the Ministry of Trade, Industry, Trade and Investment, the Ministry of Finance, the SEC, the CAC, the Financial Reporting Council, ICANN, to provide various palliatives that resulted in a few things. The most critical one being the CAC guidelines that allowed listed companies to be able to have AGMs by proxy and ensure that investors were not denied corporate actions due to them as a result of COVID-19. We also were able to get ICANN to allow for external auditors that could not move around as a result of the lockdown to exclude the inclusion of their stamp and seal for audited financial statements. These were critical because they really impacted on what companies could do as they went to the AGMs and as they reported to their various stakeholders, including shareholders. Next slide. So we believe that from a for a post-COVID-19 world in Nigeria, we need to take some and in fact all of the learnings that we've experienced in this COVID-19 period. The first one is that we must have policy inclusiveness at the government level. So let me start at the very highest level, policy. We believe that it's very important to unify the exchange rate windows and to do that as quickly as possible. The market experienced significant volatility, most of it driven by foreign investors wanting to leave the market. As you know, when you have shocks like this, there's a flight to safety. Our market is no different. We saw significant pullback from foreign investors. We saw a lot of investors moving into a gold ETF. Gold is usually associated with stability and safety. In fact, that ETF today has returned over 50%. We saw a lot of companies want to do rights issues, special placements, and fixed income in terms of bonds, corporate bonds, and things like that, just to show up their capital. And so it's important that for both domestic and foreign investors, that we're able to have just one exchange rate that everybody ties into. And I must commend the central bank for the work they've done to see us through this challenge, how active and proactive they've been. And I know that they're already moving in this direction. So I encourage them, in spite of the short difficulties, to continue with that policy and to move to unify the exchange rates as quickly as possible. The second thing that we think will be very helpful is to have a regulatory environment that supports risk-taking and capital formation. We believe that some of the forbearance that we've seen should be continued, and that governments should not be in a rush to introduce new taxes. In fact, we think that the palliatives they've offered to try to drive recovery should be continued. And it's not until we've actually recovered and in a growth phase that we can now begin to talk about introducing new taxes. We believe that it's important to even reduce the tax burden for already compliant organizations. Many of the listed companies, as a result of the listing requirements and disclosure requirements, are quite compliant, and there are many studies that show that. And so looking at ways to encourage them should be very top of the list for policymakers. We congratulate the government for actually passing and signing into law the CAMA 2020, the CAMA, the company law. We think that a number of the initiatives there are actually innovative and will bring us to the 21st century. These initiatives clearly, the shortcomings in the old CAMA law clearly showed up in this COVID-19 period. And so we're very happy that that has been done, and we encourage the government to do the same with the Pension Reform Act, the ISA, and other such legislation that would make it easier to do business, that would make it easier to take risks and to get rewarded. Finally, on the policy side, we believe that we need to do more with the public-private partnerships for infrastructure development. One of the things that caught us with this twin challenge of COVID-19 and crude oil price shock is that we did not have substantial buffers to help in cushioning the effect of some of these challenges. It should be no longer a surprise to us that every 5 years there's one shock or another. And so we must now start building the buffers that would allow us to weather the next storm. And one of those buffers is actually infrastructure. We need to do more in the infrastructure space. We like what the CBN is doing with regards to InfraCo. We encourage them to bring that initiative to life. And the listing on the stock exchange would actually help in effective reporting, transparency, and governance around such a fund. And we're very happy to work with them on that. Another initiative that we think is very good and that the government should move quickly to bring to life is converting the road investment tax credit scheme into tradable instruments that can be listed on the various platforms, including the Nigerian Stock Exchange. So we think it is those types of innovative policy making that will drive our recovery and position us well to come out of this twin challenge of COVID-19 and oil price shocks stronger and poised for growth. Finally, let's go to the last slide, please. It's very important that we also bring in the private sector and take a market approach to our next growth phase. And so embracing technology, exploring synergies within the ecosystem, and leveraging the NSC's demutualization opportunities are some of the things we've highlighted here. It is no longer a secret that we're solidly into the fourth industrial revolution. And that revolution and some of the technologies that comes with it were in full display during this COVID-19 crisis. And some of those technologies are what have enabled us and other businesses to stay open during this crisis. So it is important that we accelerate the adoption of the fourth industrial revolution and the various technologies associated with it into the way we do business, into the way we live, and into the way we operate. We also believe that gone are the days, I'm wrapping up quickly. We also believe that gone are the days when technology was a support function. Technology now has to come in front and center in developing the business models of the post-COVID-19 world. And we must critically look at the future of work. Most of us are working from home. And so it begs the question, do you really need a place that everybody wakes up to go to? And the associated inefficiencies that are in full display as a result of that. Finally, Mr. Chairman, let me just say that the Nigerian Stock Exchange remains open and very supportive of a number of these initiatives, and we're very happy to work with the ecosystem to deploy a number of these thoughts and to continue to provide access to capital raising and supporting people that are taking risks and must get rewarded accordingly. Thank you very much.
Thank you, Oscar. We must move quickly. Second presenter will be Mr. Bola Koko Onadele, whose group also provides broad infrastructure and trading facilities. So Bola Koko, over to you, please.
Thank you very much, Mr. Chairman, and distinguished ladies and gentlemen. Good morning to you. I have slides, I think just about 5 to take us through the 12 minutes. I will appreciate if the first slide can come up. The situation we are in Nigeria is not different from most economies, but I think strategies to recover will depend very much on what we do in Nigeria. And we can't recover if we do not address some fundamentals. So I'll speak to the impact on the economy and on the markets, and then take strategies from 3 different perspectives. Next slide, please. If we look at the economy today, the summary of this is the economy is, in total, the prosperity of Nigerians will be down, and the economy is down. They're declining profits, inflation is going up, people are getting poorer, some companies will fail, some may be doing well, interestingly, at this time. The economy is in ICU. Next slide, please. If we look at the markets, I will start with the primary markets where we've seen, increase in corporate bonds, but these numbers are not really exciting. So, we have 152 billion new issues in corporate bond. In this economy, these are not the sort of numbers we should be talking about. Commercial papers have also gone up 11%, but they do not excite me, and they shouldn't excite anybody. Let's look at the secondary market. That is where you really appreciate the impact of the pandemic. And again, we've had pandemic, we've had drop in crude oil price, but I think our reactions have actually caused us to score more own goals than really the impact should have, we should have felt on this pandemic. You look at the Treasury bills score. The figures have gone up from Q1 to what we saw in Q2 and a month of Q3. But again, that is not exciting because the average quarterly turnover last year was 21.5 trillion, and we're talking of 2.7 trillion. Well, we can argue that OMO bills and T-bills were fungible and they were together, but consistently we need to always focus on improving the turnover of a market because that intensity is what will attract capital. We look at the FGM bonds, a tiny drop between Q1 and Q2, but the bond has benefited because the T-bills market has completely collapsed, because if you're thinking of 21 trillion down to 2 trillion, then there's no other word to use for that. But even for the FGN bond itself, this is not an exciting figure because the trading intensity is not even up to 1. Trading intensity is the turnover divided by the outstanding amount of the stock that's been issued. This is not exciting for the market. Let's go to the last arrow. You see the negative 72. No, not next slide, the next arrow there. The negative 72 is under foreign exchange. Consistently, we've been saying in this country, when we have dislocations, the best system to cost reallocation of resources and to give an efficient way of that capital allocation is the market. Again, I think we've dislocated the market. This market had a turnover of 36 billion, average quarterly turnover last year. We've gotten it down to 12 billion in Q2. There is pandemic, but I'm not sure it's pandemic that has caused this. And when we say pandemic, twin and crude oil, one is a symptom, one is caused by the other. We had financial crisis, then crude oil price dropped. How did we react? In 2015, we were doing the same thing we did, but we started in March 2015. We came out of it by April 2017. I'm hoping that we're not going to wait till 2022 to come out of this sort of system that we're running today. If you look at the market factors below, crude has, in March, we started it at 50. It dropped whilst all of us were locked at home to 10. We were all panicking. So if indeed the Naira depreciated since that time, by now we should be seeing appreciation because it's back at 42 level, but we're not seeing that. The all-share index, Oscar already spoke to that, is up. Interesting part of it before we leave this slide, you see the first box down below with a gray mark. FX rate has been extremely stable. That is interesting, and anybody will question this. How could the crude oil price, which has got very strong correlation with exchange rate, the dollar naira, would have produced this sort of stability? Maybe the issues we have that we're saying the causes of pandemic may just be localized to what we've done with the nervous system, which is the FX market. In the next slide, we'll start looking at what to do to fix this. And that is the economic renaissance. What do we want to do? Oscar already spoke to the infrastructure development, and we must commend Mr. Balogun for the role, visionary role he played on this infraco. But why is Nigeria with a low capital market? When we talk about capital market, we're speaking to equity, bond, derivatives. It's not just the equity market. The debt capital market in this country is too low. We have no housing revolution. There's no policy for us in this country to say every 7 of 10 Nigerians must live in their own homes. We do not have such, so there's no galvanization of capital into housing. If we have housing revolution in this country, the sort of capital market sizing we'll see will be tremendous, the transformation. So for FMBQ, we're focused on big ideas and big issues. We fix infrastructure, we fix housing in this country, then we will see a much bigger market. Government has to look at privatization and sale of assets. They have to look at the capital market. as the mechanism to sort out a lot of the problems in Nigeria. We've seen the fortunes of public finance. They have to give us the enabling environment at this point. I'm not sure government has the resources to deliver on most of the promises and actions that will deliver prosperity, much deserved prosperity to Nigerians. We also need similar revolution in agriculture, and our principles have to be market oriented at each time. When we have crisis, that is really when we should embrace market. We can't play market principles, use market principles when things are normal, and when there are challenges, we quickly dislocate everything ourselves. So the base of this slide has philosophy, leadership, strategy, and architecture. We must start with the philosophy. What sort of economy do we want to run? Once we get that right, we get the right leadership, strategy will come, and architecture, regulation, legislation will all support this. I add my voice to what Oscar said on CAMA 2020 is one of the big things that will change this country, hopefully, if we adopt the right philosophy all across markets. We can't have derivatives market when the money market is poor, the FX market is poor, and we're not running all our markets with, known and very orthodox principles. The next slide would take us to market access. What do we need for strategies there? The first is capital. We must all the time respect capital. We must all the time attract capital, and we must think of retaining capital. And this capital must not be limited to listed companies. It must not be listed. It must not be limited to foreign capital when we're exciting any part of the market. We must think of domestic market. I think we've taken the domestic investors for granted for too long, and we need to start addressing this. Nobody can invest pensions at rates lower than inflation. We're creating pensioners in future who will not even have very good fortunes and be able to survive. We need to address fundamentals. We need to kickstart. In actual fact, kickstart is not the word. We've not started. Private capital. Most of the big companies you see listed on the Nigerian Stock Exchange today started as private companies. How were they funded? There's so many companies like that in this country that we need to fund, and we need to make sure that they can access capital with ease. Investments, we need to create more investable securities. Pension funds will keep growing, but where are they going to invest this money? Without a liquid FX market, we've been saying it, that is the DNA. Without a liquid FX market, all the other markets will not work. It's just very simple. We don't need to go to school for this. We've felt it, we've learned it. This country has gone through devaluations time and time again. We've seen prosperity. We'll keep forging ahead. But if the DNA, if the nervous system, if these things do not work, if foreign exchange market doesn't work, if it's not liquid, if it's not easy to come in and go out, we're going to keep having challenges, and the investor base will keep shrinking. No Nigerian will work hard, make money in Naira, and invest it in 1% or 2%, invest it below inflation, and invest it in a currency that is no longer a strong store of value. The last slide is going to speak to capital market. And I'm happy that the Director General recently appointed, Lamido Yuguda, has joined us now. He has the responsibility to take this capital market to the next level, which is the mantra of this government. I'm going to start with the repo and securities lending market. If we don't have a repo market where people that hold securities can quickly exchange for cash and take on their securities later, we're not going to grow. The incentives for listing of equity on bonds. The government should not even be thinking of revenue from these areas because these numbers are too low. We need to have a lot of work done to invest and to increase listings in this country. Oscar mentioned that as well. Incentives for corporate bonds. It is just, again, unacceptable that the corporate bond market, the figures are so low, not up to 1 trillion in this country. With the number of corporates, with the number of projects, with the number of features we need to create. Director General, there must be applications of central counterparties. We need to list them to de-risk the market. Commodity exchanges, and I end with the FX market. There's a legislation for Foreign Exchange Monetary and Miscellaneous Act of 2004. We must operate market in line with our legislation. Autonomous FX market. Let us rebuild our FX market. It will help build our capital market. Everyone, congratulations this morning. Thank you, Director General, once again. Thank you, Mr. Chairman.
Thank you, Koko, for your presentation. And I think it provides a good bridge. We've had the two major market operators or providers of facilitation in the market. Now we go on to hear from the key regulator of the market. And it's my pleasure to ask Dr. Lamido Yuguda, the Director General of the Securities and Exchange Commission, to make his presentation. Lamido, over to you.
Thank you, Mr. Chairman. Thank you, distinguished colleagues. The first two presentations were actually very interesting because they x-rayed what is wrong today, with our market. I mean, this pandemic has just added to, I think, what has really been a very bad time for the capital market. So I will not. I'll go straight to the, to the first slide, or the second slide. Next slide. Yes. So we've seen really how this pandemic has impacted, economies, around the world. Our economy, no exception. We have seen, massive lockdowns in Abuja, Lagos, Ogun State, and later, in the rest of the country. We have just seen air, transportation starting, domestically, but still we have no international flights. Events have been canceled. We are doing this in online probably, in other times we'll have been together to have this kind of seminar. We have seen, disruption in trade flows, across really all, asset markets. Next slide. So really, when you look at the Nigerian market, I think even now, in spite of the pandemic, what we have is not really that there is no, investable funds. Because if you look at the pension funds, the pension funds are today really having some reasonable amount of capital that they could invest in. They are not still investing up to the required allocations, for the capital market and for infrastructure, for that matter. And we have to ask ourselves, why, is this the situation? We have pension funds lending money to banks at 2% or less. And these banks are still the key financiers, of corporations in Nigeria, lending at maybe 15% or more. So you can see that the massive gap, between pension funds, between what the pension funds are lending, to the banks and what the banks are on lending to corporations is really huge. And if the capital market could step in, we can substantially reduce the funding cost of corporations, while at the same time improving the returns available to pension funds. So I think, the key thing in the capital market is we have to have a conversation to see what is really wrong with the market. And I am glad that on a personal level, I started having this conversation with some of my colleagues. But I think as an industry, we need to come together and say, what is it that we are doing in the capital market that really has made this over-dominance, of commercial banks, so profound. I think the pandemic has only increased, this difficulty, but we already had this difficulty even before the pandemic. Oscar has talked about the equity the currency performance. We now know that we are really going to have a major foreign exchange, a problem. The parallel market is trading in the 470s, and even lower for the Naira. Equity performance has not been really good. Investor confidence has been really low in the capital market even before now. I think it has just gotten worse because people have lost incomes and they are not really having the kind of disposable income to invest, in the capital market. So where do we really go from here? As the regulator, we have responded to the issue of the COVID pandemic, initially by issuing a number of circulars. Next slide, please. We allowed the electronic filing of returns and applications. We encourage virtual meetings, such as annual general meetings. We approved a 60-day extension. Okay, and next slides, apart from the next slide again. The next one with the tables. Yes, here, there. So we approved a 60-day extension for public companies and capital market operators to file their 2019 annual returns and also their Q1 2020 quarterly reports. We triggered our business continuity plans in the SEC, as well as also in the capital market. The CMOs triggered their own capital business continuity plans. We required issuers to make disclosures on investors on the impact of the COVID-19 of their operations. We also asked CMOs to monitor the impact of COVID-19 on their operations and manage risk. We inaugurated, together with other capital market operators, the Capital Market Support Committee on COVID, which has done tremendously well in trying to help, the government address, this crisis in terms of, giving them some financial and material assistance to fight the pandemic. We reopened the Commission's offices, to the public in a very short time. We continued to have skeletal operations with only our top employees coming to the office, while the bulk of our people remained at home, but working from home, online. And we have resumed accepting and treating applications, for registration. Next slide. So the SEC, post-COVID, is going to pay real attention to one, important thing, and that is to work to support the market in difficult, economic periods. Okay, improving advocacy and encouraging collaboration with, other regulators. As we look at the post-COVID, period, we have talked about the massive infrastructure deficit. I think the capital market can actually, finance a large part, of infrastructure requirements, in this country. But I think we need to get the policies, right for this to happen. We have seen some major operators, in the market, financiers of infrastructure, but they're actually doing very little in Nigeria. And we need to look at our policies and see what policies really will promote the financing of infrastructure by the capital market. Coco made mention of the housing market. I think we need to be really aware that most of our housing asset is actually not traded today. And I think this is a major area that we can work with other regulators and also with other participants, like the Nigerian Mortgage Refinancing Corporation and similar agencies, to really make sure that a lot of our housing assets are traded, on the market, and people can invest, in these kinds of assets. We will pay more attention to market development. The Commission's mandate is, both regulation of the market and then development, of the market. And this has to really be at forefront, this time. We must work to deepen the market and focus more on financial literacy and investor education. I think at the moment, capital market operations really appear a little complicated to some of our investor base. There was a time in the 2007-2009 period when a lot of investors actually flocked to the market, but they didn't really understand this market. And when the crash came, they essentially got afraid. Some of them made massive losses. And since that time, a lot of people have not really come back to the market. We have less than 400,000 CIS investment accounts in Nigeria, for a country that has 200 million people. And that is really telling you. I'm sure if you look at the numbers for even the voluntary, pension contributions, that will be a little, probably more than that. So I think the financial the capital market needs to be a lot more, out there in terms of educating people about what the capital market can do and about what kind of investor protection is there in the market, so that people can come back. We need to use technology a little more. We are now using technology to have this conference, to have this webinar, but we also need to automate, a lot of our processes, especially in the SEC, and we are actually now looking at the issue of automating a lot of the SEC processes, even more than what we are doing, at the moment. We will need to look at the capital market master plan. This is a very ambitious plan that was planned for 10 years. We have now done 5 years of the, of the plan implementation. We have started a review of the implementation of the capital market master plan, but there are still a lot of segments of this plan that have not even been implemented, even for the first time. So I'm looking at this with my colleagues, and really this is something that we will come to the market and discuss with the capital market operators who have really been very much a part of the capital market master plan implementation committee, to really see how we can fast track this plan so that we can achieve all of the objectives of the plan well ahead of the 2025 deadline. We will look at the emerging risks in the market, because as we are doing all these things, we need to consider emerging risks, particularly those that pose existential threats. And we'll develop measures to mitigate these risks. We will work with market players to address challenges to their operations resulting from the pandemic. And also we'll adapt and innovate. We'll review some of our methods and introduce more relevant and efficient ones to be able to increasingly adapt to innovation. I think one of the things that we have had, in the first two speakers, is that the derivatives market needs to be developed in Nigeria. The repo market and the securities lending markets, need to be developed, in Nigeria. I cannot agree more. I think these are important bits of the market that we need to develop. And at the SEC here, we will really do our best, and we'll link up with all the market operators. We'll take their ideas and mix them with our own ideas to really have, a market that all of us will be, proud of. So in terms of going forward, next slide, please. We will improve our regulations, provide remote trading, online submission of returns, virtual meetings, video conferencing, and the like. We will get better at catching market manipulation and infractions. This is something that is taking a lot of the time of the Commission. Since I came to office last month, I will say that I have really devoted a good part of my time at looking at cases involving enforcement, that is disciplining bad behavior in the market. And I want to say that the SEC will really have a zero tolerance to market infractions. Okay, we are trying to have a very fair regulatory approach, but will really not take kindly to any market manipulation by any capital market operator, no matter how big. We'll work harder and leverage technology to reduce the unclaimed dividend figures. Right now, we have an unacceptably high level of unclaimed dividends, and we have a system that really, in a way, has encouraged the accumulation of unclaimed dividends over the past few years. Now we have the e-dividend portal. It is not without its own problem, because some operators have actually worked to frustrate the enrollment of holders onto the e-dividend framework, but we'll really work hard to reduce that, and also to make sure that these infractions, these frustrations from certain operators are really ceased. We will strengthen investor protection, encourage transparency and fairness in the market. One area that we have actually looked at and that could really help the capital market a lot is the area of the CIS, collective investment schemes. And this is an area that has a large pool of monies, but with not really very clear custody arrangements. I think we are already discussing this, and we think once we fix some of the issues in this market, there should be a much larger pool of money coming into collective investment schemes.
Sorry, DG, you have to round up, please, because we're running behind.
Yes, sir, thank you. I'm just done. So we want to make it easier for issuers to access the market. Right now, our turnaround time for applications is really very, very short. We have been doing most of the things, we have been doing, in terms of, looking at applications, online. I have seen many of the applications, actually the time that they take with, the issuing houses is even more than the time that we actually, use at the SEC here to review them. So I think we'll work with issuers to see what is really wrong and make sure that no application is made until all available and necessary requirements are actually met, so that there will be little time, going back to the issuers, to the issuing houses to say, please go and correct this. And then we'll really encourage stronger advocacy, both from us and also from all the market operators. So I think this is really the end of my presentation, and I will be happy to answer questions. Thank you, Mr. Chairman.
Thank you very much, DG Sec. The next presenter is a facilitator also, a supporter of the market, but is a broader supporter of the economy, and that's the Registrar General Corporate Affairs Commission. There's been a lot of buzz around the latest act, the Companies and Allied Matters Act 2020, which was signed on the 7th of this month by the President. I'm sure Alhaji Garba will enlighten us on that and other supportive work that he's doing to support the capital market. Alhaji Garba, over to you.
Thank you so much, sir. Distinguished panelists and participants, good afternoon. My task today, based on the invitation, is to speak on some of the provisions that impact on the capital market and corporate governance. Because of the number of provisions, it may not be possible to exhaust them at this sitting. So I will simply highlight some of the key reforms that impacts on the capital market. As we may know, Mr. President gave assent to the new Companies and Allied Matters Act precisely on the 24th of July. The law is yet to be gazetted. We are actually liaising with the National Assembly for a quick gazetting of the act so that it will take effect. It's supposed to take effect immediately. The new law has 870 sections, as against the 612 sections in the repealed act. We have two legal entity types that are completely new. They are new to our legal framework, that is limited partnerships and limited liability partnership. A lot of changes have been introduced with respect to public companies, right from the minimum share capital threshold for public companies. In the former act, 500,000, with inflation and other things, 500,000 is actually insignificant. The law now has 2 million as a minimum threshold. And another significant change is the issue of authorized and issued share capital. The law has abolished the issue of authorized capital, so which means every share capital registered must be issued. The era of companies warehousing some shares to be issued at a later date has been abolished, but companies are still at liberty to increase their share capital whenever the need arises. And when they increase, they have to allot. But at the point of allotment, what the law now says is when you increase, to enable you increase, you must have at least 25% of the shares as paid up. So other provisions relate to the issue of unclaimed dividends, issue of multiple directorships, issues of independent directors. On unclaimed dividends, the law now says after 12 years, the money will revert to the company and it can be distributed. It forms part of the distributable profits of the company. So the limitation now is 12 years. After 12 years, the shareholder cannot recover. And there is also an additional obligation on the part of the CAC to publish the list in national newspapers. Some people have raised concern about issues of data privacy and what have you regarding the publication. So the companies are supposed to publish. But I don't see anything wrong with that because you are publishing without the necessary details about the address and other personal details of the shareholder. So there is nothing wrong in that approach. On independent directors, the law has set a minimum threshold of 3 independent directors for every public company. And the qualification of these independent directors has been codified now. An independent director by the new provision is somebody whose relative is not an employee of the company, was not an employee of the company, or doesn't have any relationship of the company, has not made any payment or received any payment from the company above 20 million, or doesn't have interest of up to 30% in that company. So at least we have a minimum standard. With respect to the definition, nothing stops relevant sector regulators from coming up with their own definition, which may be higher. They may introduce higher standards over and above what we have in the CAMA. Other issues that will have significant impact on public companies has to do with the registration of charges. As we all know, when a company borrows money and it uses assets to secure those indebtedness, the law says the company must register the charge with the CAC. Under the old act and the regulations, the amount charged to public companies was 2%, which is huge. So you can imagine if a company borrows 1 billion naira and having to pay 2% of that, that's quite significant. So the law now has set a maximum threshold of 0.35% as the amount payable for the registration of the charge. 0.35% of the amount secured by the charge. So this is a significant reduction and it will go a long way in actually helping these public companies. Another issue has to do with the insolvency framework. Our current insolvency framework is actually at the mercy of the lender. If you borrow money from any bank or any lender, the lender dictates the approach to be followed on this recovery. The company doesn't have any option. You just have to go in line with the dictates of the lender. We now have a provision on company voluntary arrangement and netting. A company on its own can initiate a voluntary arrangement and can approach the court to appoint an administrator where it has outstanding liabilities, outstanding indebtedness, and is likely to go insolvent. That administrator will act independent of the creditors and will manage the company to profitability. Because one fundamental issue about insolvency and companies is there are different stakeholders in every company. Apart from the creditor, you also have the employees. So the interest should not just be to recover the loan. It should be recovered in a manner that will safeguard jobs. And even the government that gets taxes from these companies should be interested in how these recoveries are made. On multiple directorship, the law says an individual can only be a director, cannot be a director in not more than 5 public companies. So there is no limitation on private companies, but you cannot be a director in not more than 5 public companies. And the law has also codified the issue of combining the responsibility of a chairman and the director, and a managing director. So one person cannot combine these 2 responsibilities. Other issues relating to conversion from private company to public company. Under the old law, once a company passes a special resolution and it meets the requirements, it can go ahead and convert. There is no window for a shareholder to object, even where he feels that should not happen. The new provision has given a shareholder with 5% of the shares or 5% of the voters' right, he can challenge that resolution in court. And once that action is filed, the process has to be suspended until the court makes a pronouncement. So another provision has to do with issues of shares at a discount. Under the old law, shares could be issued at a discount, but this is completely prohibited now. So, but nothing stops a company from giving commission when it's selling its shares. But to issue shares at a discount, that is not allowed. On meetings, unfortunately, when this CAMA the first draft was issued and even the final draft, nobody contemplated that the world would be in this kind of situation. So issues relating to electronic meetings were limited to private companies. There are no provisions that allows public companies to hold electronic meetings. The only requirement with respect to public companies relates to an additional requirement that a company may send notices of meetings electronically. But that does not absolve the company from its responsibility to either send personal notice or to send a notice by post. So this is an additional requirement. This is one area that we need to look at for possible amendment because the world has moved and with technology, everything is possible. That was why we are careful in coming out with the regulations, with the guidelines for annual general meetings by public companies. We are mindful of the provisions of the law. We didn't issue any guideline that allows for electronic meetings. What we did was to allow meetings by proxies. If the shareholders allow 5 persons to meet to take decisions on their behalf, these are the proxies. If the proxies decides to meet electronically, we'll look the other way. But to have a platform where, they have introduced additional measures where shareholders can join and participate in the meeting electronically. That is still okay. But to call the meeting electronic meeting, this is not supported by the law for public companies. And because of issues of requirement of notice and other things. And we should be mindful of the provision that says a shareholder should be given notice, and that notice has to be either personal or by post. And failure to send that notice invalidates whatever is decided at the meeting, except where that failure is accidental or due to inadvertence. So these are some of the changes. I don't know whether it's possible to exhaust most of these provisions, as I said, at this sitting, but I believe I have covered most of the issues with respect to the capital market. I'm sure there will be questions on this. If there are gaps, maybe I will use the opportunity in the question and answer series to address these gaps. Thank you so much.
Thank you very much, AD Abubakar, especially for finishing on time. Our next speaker is Mr. Bolaji Balogun, who is a capital market authority and certainly one of the key operators of the market. After hearing from the regulators, from the providers of the facilities, it's good now to hear from one of the active participants in the market. So Balaji, over to you.
Thank you very much, Doctor, and good morning, fellow panelists, ladies and gentlemen. Firstly, I'd like to thank you, for what you do, Doc. I believe that in this, your new career, in many respects, your influence will be far more significant than in everything else that has gone before. And I say so because I really do believe that many of the solutions to Nigeria's development are really around how we can strengthen our capital markets. And developing our capital markets is really, really imperative. No country in the world ever really developed successfully without building very deep, very liquid domestic capital markets. It's primarily about local currency. That's the one currency in which every country in the world can finance safely and essentially understands that it is not creating a significant FX tail risk that it is not able to hedge. Accordingly, the markets become important for everything from financing infrastructure to financing housing, to financing SMEs, to financing our largest corporates. And this is really why developing these capital markets can be very, very central to Nigeria's development. If you run with me to my slide 4. Slide 4 really provides a very, very important reality and background that each and every one of us must understand. And that is that the federal government's budget and government's wallet is significantly constrained. And this is not a Nigeria-only problem, but in Nigeria's case, this is quite exaggerated. And what are some of these realities? Our 2020 budget, which is our largest ever budget, is only 7.5% of GDP. What does that mean? That means effectively that 93% of the economy is being financed some other way, and that actually government is a smaller factor of the economy as a whole. But let's look at that government budget and how it's spent. And what's quite scary is that 79% of it is spent on recurrent expenditure as well as debt service, and only about 21% of the government's budget is actually available for CAPEX. Now, let's assume all of that were genuinely real CAPEX and capital expenditure. All it amounts to is 1.6% of GDP. And if you bear in mind that Nigeria's population is growing faster than government's expenditure is growing, then you recognize, the issue we have. And that issue is that whether we like it or not, we must be able to access and attract private capital. And this, journey will be successful if our markets are able to attract domestic as well as international institutional private capital. If we'll turn to our next slide, I do believe very, very fundamentally that financing infrastructure is very fundamental to everything that we do. And I say so, and many people will be up in arms and say, why not education? Why not healthcare and so on? But I'll try to explain it with this cycle of prosperity, that we've developed within our business. And this cycle basically says that if you focus on financing infrastructure in power, in energy, because in our country we have this beautiful blessing of oil and gas, in transportation networks, and in broadband, because we have this incredible blessing of young people and very, very talented young people all across our country. If you focus on investing in those 4 critical areas, and you also focus on utilizing all of the benefits that the markets, afford us. So we do it utilizing conventional instruments. We do it utilizing, non-interest Sharia instruments. We do it utilizing sustainable finance instruments. What we end up doing basically is to attract investments. into agriculture, into mining, into SMEs, into education and healthcare. Why is this relevant? Those investments ultimately will create jobs. And why are jobs relevant? Because we're a country of 200 million people that will become 400, that will become 500 million at some point. And they also tell us that at some point before 2100, we will become the second most populous nation on earth. Therefore, we not only need to be planning for today, we need to be planning for the next decade and for the next 30 years. And in many, many respects, every single issue that we have to deal with, to a large extent, can be solved by infrastructure. As an example, you know, as an example, if you and I think about education today, right? And we move away from our traditional paradigm of how we went to school, and we went to school in a traditional classroom, and we look at this mobile device, and we recognize that this mobile device can be a channel for dispersing education, then you'll understand that there's no reason why we should have an educational problem in Nigeria if we can solve two infrastructure issues. If we have power and broadband is affordable, every single child in Nigeria, in every corner of Nigeria, can be well educated. Today in our country, there are young people that have never ever been to school who are able to code or learn a skill on YouTube. And that is the power of broadband, and that is the power of this mobile device. I would move on to my next slide. And let's understand why markets are really, really important. Traditionally, we've always thought about banks. Then we've also always thought about the role that DFIs, or what we broadly call overseas development assistance, can play. But we're not really understanding where the real depth in the markets are. And all of the global overseas development assistance that we talk about is broadly somewhere, you know, just under $1 trillion. But today in global asset managers, institutional capital invested around the world is somewhere around $135 to $140 trillion. So this is the real market. So if we recognize that markets are critical and that private capital will be critical, then what we have to focus on is how we unlock institutional capital, both domestically, and what we're beginning to do with our pension funds is a good pathway to that, but we also have to do so regionally and globally. And this is the only way that we're going to deliver all of the large needs that our country has in infrastructure, in housing, and in social infrastructure areas like healthcare and education. I'll move very quickly to my last slide. And one of the key things when you look at our market, and it's always important to focus on the buy side. So I talked about the important role that institutional capital can play. But I ask you all the question, where have all our retail investors gone? And I don't think that as a market we've spent enough time looking at and trying to understand where our institutional investors have gone. And they've gone, some of us will think, because of the difficulties that markets will have. But all markets will have difficulty at various points in time. I think it's really important to understand what has really happened in our markets. And when we look at the CSCS, there's one shocking statistic that stares me in the face. And that is that the average age of a CSCS account holder is over 50 years old. What does that mean fundamentally? That means that the capital markets in Nigeria has completely lost a generation, and we all have a responsibility to focus on how we bring that generation back to the markets. And why have we lost this generation? We've lost this generation primarily because everybody associates capital market returns primarily with stock market returns. Whereas we've forgotten what is most important about capital markets. We've forgotten the key messages of principal preservation and yield. We've forgotten the key messages of compounding and the benefits of compounding over duration. Why are these things important? Accessing the bond markets and accessing fixed income markets in Nigeria are thought of as things that are only available to institutional investors. But whether directly or through collective investment schemes, these markets are actually really, really important to retail investors. And this is the underpinning of principal preservation. A retail investor never wants to hear that I put my money in a market and that money went down. The second critical element is really around what we do around financial education. And I'm so thankful that every single speaker prior to me, and most especially our new Director General at the SEC, has stressed the importance of financial education. You can make money in the stock markets, but you have to understand what you're doing. If, for example, you have been invested over the last 10 years in the 8 most liquid stocks in the Nigerian stock market, there is no year over the last, over the last decade where your compounded average annual return is not over 20%. But that's around understanding the importance of liquidity. And this is what really skilled investors, particularly a large amount of the international portfolio investors who invest in our market do. They follow liquidity. And this is why financial education and providing some of the skills that we have to every Nigerian is really, really important. How are we going to address these 2 key issues of retail investors disappearing from the market and the low levels of financial literacy and education? And I put it to all of us that without a digital strategy, right, without recognizing that digital is not only about what COVID has placed on us, but digital actually is our new normal going forward and is about the fundamentals of the market. It's how we take the market to that last mile retail investor who today feels left out of the market. It's how we disperse financial education. It's going back and thinking about the infrastructure of our markets and recognizing that below the big marketplace providers and the infrastructure providers like FMDQ, like the NSC, like NASD, and so on, that there is room for another layer of distribution. And whether it is our capital trade points or some other means, there needs to be a way in which we are engaging directly with that last mile, that retail investor. There needs to be a way that we're developing and dispersing financial education. I would say in summarizing that I fundamentally believe that the capital markets can be an incredible source for developing our markets, and each and every one of us has an incredible responsibility of working hand in hand with regulators, the marketplace providers, but also most importantly with listening to investors and listening to marketplace providers. Because to a large extent, I sense that sometimes, we may have been running ahead of the markets in which we're operating. Thank you very much for providing this opportunity, Dr. Usman. Thank you.
Thank you, Bolaji. Thank you. We've now covered all our main panelists. It's just the discussant. But we'll take, as we said, we take a 2-minute intermission just to do the survey. It will appear on your screens right now. You just answer yes, no, or I don't know. The poll questions are there so that we can analyze the results and tell you before the end of the webinar. So please, all our participants, answer the questions, please. Next set of questions. So just about half a minute more. We've received more than half of the participants have actually answered the questions. Yes. Okay, I think we should proceed now I'll call on Dr. Sarah Alade, who is the Special Advisor for Economy and Finance to Nigeria's President, to act as the discussant. Sarah, over to you, please.
Thank you, Chairman. And let me also thank the panelists for a job well done. I mean, it's nice to listen to experts talk about the capital market and talk about their strategies going forward. So we've listened to both the regulated and the regulator. And one of the things that has come through is that given the challenges we have, then policy has to be supportive. Supportive not only of the market, but also of the economy. In supporting the market, we'll be supporting the economy generally. So I'll just briefly talk about the monetary policy, what has been done, and what, going forward, the areas we should look at. Talk about the fiscal policy, and then give some global examples of some countries, what they have done to support the capital market, and then and then conclude for strategies in terms of fiscal and monetary policy options. Thank you. So in the next slide, I start with the monetary policy and the capital market. Just a few of the policies that of monetary policy that we had seen in the COVID area. The managed floats had not been as expected, largely because of the fall in oil prices. External reserve hasn't been what it used to be. And therefore, once you have that kind of thing where Forex is no longer coming in from our dependence on oil, then the management becomes a little bit trickish. So this has affected local and foreign investor sentiments, and we've had it from everyone, and resulted in negative net foreign investment inflows. We've also had very reduced remittances inflow as well. So whichever way you look at it, inflow had been constrained. Then we also had restricted OMO market participation, which created an increase in system liquidity and spurred demand for corporate bonds. Consequently, this has encouraged private firms to tap the Nigerian debt market for cheaper working capital. So there's been a lot of increase in corporate investors' participation in the capital markets, but the environment had been a very low yielding one. So the restriction triggered a hike in demand for bonds and resulted in declining yields, which is what you have today. The lower yield generally is expected to, which has led to lower borrowing costs for government and free up funds for other essential expenditure items in the budgets. That's what the the lower yields in the markets. That's the advantage it has to the government. But why this is, theoretically, I'll say, why this is expected to support economic growth, because then government can tap into the market and borrow at very low rates. There's also now the problem of rising inflation. And as inflation increases, the real interest gap, becomes negative in terms of real returns for investors. It's negative. And that has implication for investors, whether they are domestic or they are foreign. Negative returns does not encourage them to invest. Then we have the implementation of the minimum loan to deposit ratio of 65%, which has increased new loans to domestic economy in the year. If this continues, we expect that productivity level, barring all other things in the real sector, should improve. This is expected to encourage economic recovery and macroeconomic stability. It has, like I said, led to improved credit to the private sector. And if credit improves to the private sector, we also expect that somehow it finds its way into the capital market. Now, in the next one, I'll talk generally about the Finance Act 2020 and what it has, its impact or its effect on the capital markets. Most of the key difficulties around the cost of investments and other capital market transactions were addressed by this law. You have the regulated securities and lending transactions. The Act provides clarity on the process and the tax consequences of regulated securities lending transaction. It also involves the exchange of, it's also the issue of it addresses the issue of multiple taxations on the regulated securities lending transactions. It was addressed in that Finance Act 2020. The Act also introduced the concept of thin capitalization, which had been a problem. And according to the new law, 30% of EBITDA benchmark is the limit for interest deduction on loans by a foreign connected person or company. The Finance Act proposes to resolve the conflict in SITA provisions by removing the requirement of unit trusts to deduct withholding tax on dividends paid to their beneficiaries. And these are all issues that were, addressed and that government is trying to do to be able to, support the capital market. Next. Now, using the fiscal and monetary policies to propel growth of the capital markets, what do we need to do? One is what the government is working on, harmonization of federal and state taxes, which we hope will encourage investors, whether they are local or they are foreign, and we also, improve our cost of doing business. We also have the improvement of external reserves. I've already said, like most other people, that the oil prices has not helped in terms of our reserves. The central bank is already working on harmonization of exchange rates so that we do not have multiple exchange rates. But the important thing for investors is also to have an exchange rate that is market reflective, market determined, a willing buyer and a willing seller. So in the process, we do hope we'll come up with something that will be able to attract investors as well. And then the issue of inflation rates, which has been ticking up, this must also be addressed so that you don't have negative real returns on investment. Otherwise, investors are not likely to stay with you. Closing the COVID-19 relief funding gap, governments, because of the low revenue, we know that meeting the funding and boosting the markets will have a lot of things. Meeting the budgets of the government. Balaji already went on to what the budget of government looks like. And so government will need to be able to do that. The relief, a lot of stimulus was done. Relief was granted to some businesses, small businesses, as well as medium businesses, medium scale businesses. But we could do more. And what is restricting, what is limiting the amount that government can do is the funding. So there will be, it's important to be able to have long-term bonds, maybe which will also help the capital market and also help governments meet government's needs. And a buyback program of maturing government securities will increase market liquidity. Speakers have already talked about liquidity in the financial markets. We will need a lot of liquidity to be able to show up that. And in that case, we'll just go, I'll talk in the next slide about what other countries have done. Financial market liquidity is not peculiar. The lack of liquidity in the financial market is not peculiar to Nigeria alone. And we have other countries. I just picked a few countries that have done something in that area. In Colombia, the country was able to buy back private debt with a maturity of less than or equal to 3 years, just to allow liquidity in the market. And they also allowed non-bank institutions to participate in repo auctions. In EU, there was an introduction of long-term refinancing options to bridge funding gap. South Africa initiated a buyback program as well for government securities in the secondary markets. In India, allowing non-bank standalone primary dealers to participate also will be liquidities. In South Korea, bank debentures were included as eligible assets in open market operations. So these are what countries are doing. There are other countries with a variety of things to introduce, to make sure that the financial market is liquid. Then you have the Forex support program, again by countries. Some have entered into Forex swap program. Others have done some other things a little bit different. In India, for instance, there was a 6 months US dollar sell-buy swap operation. And others, direct currency swap lines were opened with Federal Reserve to be able to provide, again, liquidity into the foreign exchange market. So capital market regulatory relief, the regulator is already here, talked about it, but in some other countries, in South Africa, for instance, there was temporary suspension of market maker obligations on exchange traded products. And in India, temporary relaxation of compliance requirement for mutual funds. We'll have to do what works for us. And capital market stability supports, European Union suspended short selling of shares. And in South Korea, close monitoring of markets, developments, and prompt provision of financial supports. Next slide. So let me conclude. Liquidity is important, and like we see in other countries, it will be for the capital markets to be able to come back to life. It is important that liquidity is provided. And it is also important to have the right mix of fiscal and monetary policy. We do not want to overburden monetary policy beyond what it's gone. There must be the right mix of policies. Policy actions must be implemented to make all the markets function again, each of the markets, both the money markets, capital markets, as well as foreign exchange markets, all have challenges at this time. The government is also encouraged to use the capital market as a tool for stimulating the economy so that it can use it as a viable domestic financing option. A lot of the things that government would like to do, there's no funds for doing it. It can approach the capital markets. That will then, restore the capital market as well as provide funds to government. Lastly, confidence is important. And we must we must be able to show up investor confidence in our market. Confidence is the pillar on which a market economy thrives. And unless we are able to then, improve confidence, encourage investors, whether they are local or domestic, whether they are domestic or foreign, they must have confidence in this economy. They must have confidence that the policies we make, we will implement, that they must have confidence that when we will adjust not only at the, we will make adjustments and we will make it at the right time. And they must have confidence that our policies will not stop and start. There must be certain level of certainty in the things, in the way in which we operate and in the way in which policies are made. Thank you, Chairman.
Chairman, you need to unmute.
Thank you, Sarah. We have time for a few more questions that we can take. In the meantime, the polling continues for those who have not been able to complete it. I will read out the questions, some of them that we have been able to note. Unfortunately, we can't answer all the questions, but we promise you, we've agreed with the panelists that we'll send all the questions to them and they will try and respond to as many as possible so that we can send them to you, those who ask the questions via your email. The first one is this issue of liquidity is important. Almost every presenter has made this point. So Abiodun Akinjayeju has asked this question: how do we create liquidity in the domestic capital markets? And I think I'll ask Oscar, the CEO of the Nigerian Stock Exchange, to take on this question. Oscar, over to you.
Thank you very much for that question. There's a popular saying that liquidity begets liquidity. It's almost like the chicken and egg question. Liquidity is critical in the markets, and a few things that other markets around the world have done to drive liquidity include, from a policy standpoint, driving confidence in the economy and in the markets. At the operator level, creating a platform with the appropriate market structure to support generation of liquidity. So having market makers, having appropriate safeguards around limit up, limit down, but giving you enough bandwidth to play with. Pricing, the priority queue, if you will, in terms of how orders are executed. All those things are very important for liquidity. So looking at where we are in Nigeria and taking our own context into consideration, we must engineer a construct that drives, so the levers, those issues that I've just raised, that will allow you to maximize liquidity, given policy, given operator and regulator and participant activities in the market. Thank you.
Thank you very much, Oscar. This question is from Charles Udora. He says, can the establishment of regional exchanges or capital trade points facilitate unlocking of more redundant capital in Nigeria? I think the DG of SEC should take this question. Dr. Yuguda.
Thank you, Mr. Chairman. I believe we already have a number of exchanges, in the capital market, and what we have is really not a dearth of exchanges, but really, not enough transactions, given the size of our economy. We have exchanges that cover bonds, equities, commodities, ETFs, We even have one for smaller companies, the NASD. So these exchanges are efficient and investors can easily access, their, services from anywhere. So I do not really see for now a need for regional exchanges. I see a need for commodity exchanges, which have sprung up actually in the last few years, because we have a very good agricultural, potential that we need to, exploit. But as for regional exchanges, I think for now, we are not really looking at that area, Mr. Chairman.
Thank you very much, Lamido. Nafiu Halilu asks the question, what do you think is the broader takeaway message? And I think since Dr. Sarah Alade was the one who provided the discussion, looked at everything, how would you answer that? What would you say should be the key takeaway from this webinar?
I think I wish I know who is asking that question. If he's a young person, we want him to come to the capital markets. I think that's one of the takeaways that he should then.
He works for the Jigawa Investment Promotion Agency.
Very good. So that's one takeaway that we would like him to do. But I also want to say that it's important to know that both the regulators as well as, SEC, the regulated, are also doing things to be able to, encourage investors or to show up what is happening in the capital market. So we should know that even though there are challenges, the market is not just keeping quiet. A lot of things are being done. From my side is to also know that government is trying to do its best to encourage liquidity to come into the market so that both the capital market and all the other markets can, be restored so that we can then have sustainable growth, which we hope for. Thank you.
Thank you. Ibidapo Oyewale, Office of the Speaker, House of Representatives, asks, what are the implications of the falling Naira value and how can this be tackled? So it's not just the availability of Forex, but the falling value of the Naira. I think I should ask Bolaji to address this because you raised that issue, the issue of the foreign exchange market. Bolaji, over to you.
Thank you very much, Dr. Osman, and thank you for that question. I would rather have docked and allowed, a number of panelists who are way more qualified than myself, to speak about FX markets. But I want to attack it from, an economics perspective and a long-term perspective. And that very, very simply is that the only way that we're going to get to a stronger currency, whether we like it or not, is to build a diversified economy. The only way that you build a diversified economy, which is, less dependent on commodity cycles, essentially is to invest, whether we like it or not, very substantially in the base of infrastructure in the market. Today, we're a country of incredible blessing in agriculture, okay? But all of that agriculture, unfortunately for us, is low value because we haven't built the transportation networks to take the product from the farms to big city markets and home tables at home, or to ports and airports to export it. We haven't built the cold chain infrastructure to add value, to preserve and process a lot of our agricultural produce. We have not the electricity. And without electricity, sir, we cannot preserve, we cannot process agricultural products. And that's just one area where you can diversify this economy today. The other opportunity for diversification that we have is that our country has an incredible blessing of many, many minerals, apart from oil and gas. But without building transportation networks, and in particular rail and roads from the mining territories across the country to the ports, it is not impossible. And in many respects, the work you did, Dr. Usman, many, many years ago, putting together a national infrastructure master plan is really very, very critical to how we get long-term currency stability. When you diversify the economy, you bring down the cost, you firstly increase the options that we have for generating increased foreign capacity. We substantially increase import substitution, therefore putting less pressure on the currency. The other thing that we do most importantly is that we create, a much larger, much more resilient economy that is able to respond to any shock from any part of it because it is much more robust and diverse. So diversification is really, really key to delivering that. And infrastructure is the underpinning of that.
Thank you very much. Aisha Bako has asked this question. What is the critical role of the private sector in this recovery? Actually, it's a double-barrel question. What should be the priorities for the next 12 to 24 months? Bola Koko, I think you should take this up.
Thank you, Chairman. As Bolaji Balogun said, maybe there are other people more qualified than me to speak to this, but I have passion for private capital and private sector, so I'll make an attempt. I think Nigeria needs to start with the understanding that, or agree to the philosophy that it's the private sector that's going to do almost everything we need to get done in this country. Once we start with that, which is the philosophy for me, then we can start addressing what would we need, enabling environment and so many other things to ensure that we drive the revolution we need. Private sector in education, health, broadband, infrastructure, almost everything we need to do. And we start by helping in respecting capital, because the people that have this capital and decide to risk it, to invest in different sectors, we need to respect what they're doing. And we need to respect the fact that they're taking major risk in helping to develop this economy. In the presentation, Balaji spoke to jobs. Quite honestly, the president, that is what the president needs to have in front of him every day. What are we doing that will promote jobs? Not for public sector to start hiring people into different agencies. That's not what we're talking about. We're talking about decisions, policies we're taking. Some of them they are, but we have a lot of decisions to take. We've spoken to markets. The government has released the Nigeria Economic Sustainability Plan. Markets are important. Bolaji speaking to the foreign exchange market. There has to be some short-term things we need to do now. We need to open that market. It needs to start functioning heavily. And then we have medium-term strategies and we have long-term strategies. And as Dr. Alade said, we cannot be changing policies every day. Once they know, and that is what the confidence we're talking about. And there's so many other things to encourage private sector, all these multiple taxes. I just think we have not really sat down and decided what we want to do and to list out the things we must do. There's so many caudal and conflicting strategies, actions by government. In a country with this high level of security, we should be driving creation of jobs as if, those numbers Bolaji mentioned about population, I'm just hoping that they won't happen. It would be great if they happen and we have infrastructure, will be a phenomenal force in this world. But if we're approaching things this way, we're not creating jobs, we're not opening sectors, we're not allowing markets to function, we're not driving infrastructure, we need to be attracting capital. You can't attract anyone to come and invest in infrastructure here. 30 years ago when I was a trader, exchange rate was 9. Today it is 400 or whatever figure you want to believe. And you need to have hedging products. You need to have a way that you preserve their capital. Nigerians don't even want to save here in Naira anymore. I just think we have not decided on what we're doing and where we're going. There's just too much to talk about. I don't know. Mr. Chairman, I'll hand over to you, quite honestly.
Thank you very much, Coco. I will combine these two questions for the DG SEC. You have actually indirectly answered the questions. It's about the introduction of new investment products to the market. Abdullah Garko of Stanbic IBTC asked, when specifically would stock futures be introduced in the capital market? And then Muhammad Ghazali Suleiman, he says, what is the role of non-interest or ethical finance in all this, in the market?
Thank you, Mr. Chairman. I believe stock futures will be introduced soon. We already have, applications for key infrastructure in the derivatives market. We have applications from, the two major, exchanges, that we have. So this is really something that is on the front burner, at the moment. What role does Islamic or ethical finance fit towards the recovery? I think the non-interest segment of the market is very key, to our economy. It is one of the main pillars of the capital market master plan that we're implementing. And we're also working to make sure that that segment is attractive to both issuers and to investors. We see that the sovereign issues of Sukuk have been very successful so far, but we have not seen a single issuance of a corporate Sukuk, at this time. So I think we will also talk to Coco, Oscar, and other colleagues in the market to ask really why is there no corporate interest so far in the Sukuk product, because I think investors have become really used to the fact that this Sukuk is a good investment product. So we will work towards that, and I think it's really, the risk return profile of a Sukuk is quite different from that of a conventional bond, and I think that really should make it attractive to a number of investors. Thank you, Mr. Chairman.
Thank you. This question is to the Registrar General CAC. The person didn't indicate their name, but it's a double-barrel question as well, that it took 30 years plus to actually review the Companies and Allied Matters Act to the one you have in 2020. Is it going to take another, what provisions do you have to ensure that the new revision does not take up to another 30 years? The second part of the question is, you are still specifying penalties or Naira figures in absolute Naira. With time and inflation, these Naira figures will become almost nonsense again. So, and changing the law becomes very difficult. Isn't that an unwise step to have taken at a time you are doing a major review like this? RG, over to you.
Thank you. Okay, thank you so much, Mr. Chairman. That's a good question. One thing with laws is no law is perfect. No human law is perfect. Already we have started compiling possible areas of amendment. We are not going to wait for another 30 years. This I will assure the general public. We started compiling. I have mentioned the issue of electronic meetings for public companies. This is one area that we are looking at. We want to use technology. It should go beyond private companies. So the assurance I want to give to the person that asked this question is this will not take another 30 years. We're already compiling possible areas of amendment. On penalties, most of the provisions on penalties have not been specified. They have been moved to the regulations, which means CAC will issue regulations specifying the penalty that will be charged for all infractions. So that has been addressed, and that was a deliberate effort to avoid a repeat of the mistakes of the past. So these are my answers to the two questions, Mr. Chairman.
Thank you very much. We have promised everybody that we are finishing this webinar in 2 hours at 1 o'clock. But maybe just one question before I conclude. And this is directed to the CEO of the stock exchange. The issue of unclaimed dividends. I think Ibrahim is asking, can we explore the possibility of using these for margin trading? And perhaps more generally, what is the stock exchange doing regarding, I know you're working with SEC, but what is the plan regarding these huge unclaimed dividends?
Okay, I would echo what Coco and Balaji said already, that I'm not the most qualified person to answer this. I'll give it a shot. So we think that this issue is an issue that has been on the front burner for some time. The SEC has, in its own way, tried to galvanize the entire capital market to address the issue, and we're very supportive of the efforts. The CAC is also coming up with regulations, there are news around what to do with this. We believe that a construct that allows you to put those funds back into the development of the capital market, margin trading, bid order uses, would be the best thing for the country. So sending it back to the companies that have already declared the dividend and have moved on may not be the optimal use of these funds. Let me just say something about margin trading. Margin trading is going to help to address the liquidity question. And so it's about time that we put in place a framework to help to bring back glass. So, Mr. Chairman, that would be my response.
Thank you very much. Well, our panelists and our distinguished participants, I'm sure we can go on and on. The issues are quite huge. They are very important. All I will assure you is that this, for us in Susman Associates, these are a webinar series that we've started. As you've seen in the questionnaire that we circulated, we intend very soon to follow up on this one with a much more intensive, where we have probably fewer number of people, where we can deep dive into some of these issues. We'll be letting you know very soon as to the date of that webinar. And there will be a very distinguished panel like we have here. So on behalf of all of you, let me thank our distinguished panelists for your time and the excellent presentations that you have made, but also our participants. At a point, we had, I think, something approaching 380 participants. So thank you very much for your participation. We'll be getting back to you with the slides, and we will prepare a detailed summary of the presentations and your opinions and your questions, and get back to both our participants and to our panel. So on behalf of Susman and Associates, I thank all of you and say good afternoon and have a nice day. Thank you very much.